Good evening, and welcome back to ASMR Money Mentor. And actually, I should say, welcome back, Evan. Good evening to myself for coming back. So thank you for joining me on another week of episodes. We'll get started in just a moment, but you must grab a beverage. Cheers. It's been a while since I had my teacup. Cheers again. Sit back, relax, and enjoy another week of episodes. And you know, I'm actually producing this episode, or these episodes, the week that I said I was going to be off. Go figure. But I like to have episodes in advance because I don't like working at the very last minute. Do you guys? It's not good, right? It's not good to be working at the very last minute and try to get things done. It reminds me of a movie I saw years ago called Broadcast News with William Hurt, Holly Hunter, where they're scrambling around and trying to produce the newscast at the very last minute. And it takes me back to my college days where I worked in television. I worked in public television. I was a floor manager. I was the audio person. I was the camera operator. I was the technical director. I was the assistant director. And then I was the director. It was a 4-year journey, and I really loved it. But television production was very competitive in the early 90s when I started looking for a job. You can go back and watch my other episodes where I talk about my youth, the passing of my youth. That sounds so dramatic, but anyway. Sometimes in life you have to pivot and do other things. There's nothing wrong with that. You can still be a success in life if you decide to do something other than what you went to college for. So for those of you that are watching that may have recently graduated and you're out there trying to find a job, don't be surprised if maybe life will go in different directions for you. And again, there's nothing wrong with that. Look at me. I became a success even though I had lots of time where I was not very successful. And yet it's those times that create the person that you become. So how is that for an introduction? Coming back to the show, I had no idea I was going to ramble about that. You just never know what's going to happen on ASMR Money Mentor, which is why I appreciate all of you coming back. So, what are we going to be doing today? Today is Monday, April 28th. I'm going to talk about Social Security and how it is more meaningful to me than I actually realized. I know you're probably thinking, Evan, what are you talking about? So give me a few minutes. I'll go circle back to that topic in just a moment. It's very significant, so stay tuned. tomorrow, I produced a video already of me sitting right here, rambling like I normally do, about my 2025 budget and how it's underfunded. So come back tomorrow because I'm going to walk you through how you can also revisit your own budget and change it as the year goes on. Wednesday, I had a really wonderful comment from somebody a couple weeks ago. A young person that wanted me to talk about the differences in media today versus many years ago when I first started my investment journey. So I'm going to talk about two very significant people in media that shaped my destiny. That sounded so dramatic, but it's true. Thursday, I'm going to have my first car ASMR video. You're going to see me driving around in my community, and we are going to go to the beach together. Yeah, it's only a couple miles away. So I'm going to share that with you on Thursday, so come back. And Friday, what is my working title? Age 62 never looked better. Something like that. I'm 59 years old today. For those of you that are new to my channel, I've had many subscribers last month, so congratulations for clicking that subscribe button. I really appreciate it. And for the rest of you that are not subscribed, because I know there are many of you, click subscribe right now. I would appreciate it so that can help me grow my channel. I would love to get to 4,000 subscribers by the end of the year. So help me towards that goal. I would really appreciate it, which means I can spread the message of financial independence to more and more people. And while we are at it, everybody click that like button right now. Just give it a little tap, 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 tap. I usually ask you to do that at the end of the video, but I'm going to start trying to remember to tell you to do it like right now. So click the like button right now. And while you do that, I'll just sip my tea. Okay, thank you so much. I really appreciate it. And now, on with the relaxing episode. And by the way, I have no ads, remember, right now in my videos. So for those of you that like to fall asleep, please do so. I hope you find this relaxing. You may also have noticed there's a little bit more ambient noise going on. So I'm going to experiment with like total silence and ambient sounds as well. So if you think about it, maybe let me know in the comments, what do you prefer? Do you like those background sounds, or do you like it to be completely silent, 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 with whispers? And now, on with the episode. So, for those of you that have been with me for a little while, over the past couple of weeks, I've created some episodes where, remember, I was talking about that period of time that I'm in right now. I think I even talk about it Thursday when I'm driving around, going to the beach. When you retire early, if you decide to retire early, the main thing that you hear that people talk about is coming up with the money to pay for the health care premiums. Because let's face it, if you're working right now, your company most likely is paying the majority of your insurance premiums per month. And you may also know that for 2025 right now, I'm qualifying for the pretty much the maximum credits that you can receive through Marketplace, the government. It's a website where you go and you get insurance. And because I'm going to only show $16,000 of income, that's a 1/6 for 2025, I told them when I applied for the insurance that my income will be about $16,000, so I'm getting the credits now. But if all of a sudden you make a bunch of money and then you do your taxes at the end of the year, you could have to pay back some of those credits that you're receiving throughout the year. That's how that works. And I have income from interest on my CDs and also my paychecks that I received from my employer before I retired in January of this year. So that's just a little bit of a recap in terms of how it works. It's really interesting to me, but healthcare, those premiums are very expensive. If I did not have those credits, I would be paying $12,000 for the entire year. That's a lot of money. So that scares people sometimes, right? They get a little scared and they say, maybe I should not retire early. That's what keeps people working longer, even though they may have the money, or they may qualify for the credits through Marketplace, which I just talked about. And so in my previous videos, do you guys remember, I was thinking at that time that I had to find a solution for 5 years, age 60, 61, 62, 63, and 64, to come up with a way of selling shares from either my taxable account or my traditional IRA, because that's all pre-tax money. Because when you sell the gains on the taxable account or you sell the shares from the traditional IRA, those then qualify as income through the Internal Revenue Service, the IRS. And so, do you remember I was saying that I thought I needed to figure out a way that my taxable account could have enough capital gains and to qualify for 5 full years. But then I realized, oh, wait a minute, I can also use my traditional IRA. But there was something that I overlooked completely that I want to share with you right now. Does anybody know what it is? Given the fact that I'm going to take Social Security, remember, early at age 62, do you remember me rambling about that? Well, what happened was my friend Michael, that I told you retired a year before me, we were on the phone and even at dinner talking over the course of several weeks about the fact that I felt like I had to sell those shares for 5 years in order to get the income requirements through the IRS. And he started rambling, and he said in his plan he was going to, that counter for that qualification would stop at 62, 62. And I said, no, 64, right? You got to go all the way up to 65 for Medicare. And he said, yes, but I'm taking Social Security early at 62. And I said, well, me too. And he said, well, Social Security income counts towards ACA. And I said, what? He said, I'm pretty sure that Social Security income counts towards the income requirement to qualify for the Affordable Care Act. See, I didn't realize that. And that to me is huge. Huge. A very big revelation. If I'm right, I Googled it. And sure enough, it said, yes, when you start taking Social Security, like for me at age 62, which by the way is a major incentive for me if ACA is still around when I'm 62, is a major incentive to take it early, because then whatever the minimum income happens to be when I'm 62, like right now at $16,000. Whatever the federal poverty line is at that time, I think is what that $16,000 is. It's roughly $16,000. Maybe it's $18,000 in a few years when I'm 62. Regardless, do you remember my Social Security income is going to be about $25,000 a year? So check. In other words, at age 62, I would not have to sell any shares from my traditional IRA, which I really want to keep for 15 years anyway and not spend that money, or my taxable account, because the $25,000 will cover the requirement. So check the box. When I do my taxes at the end of my 62nd year in 2028, Social Security will satisfy that requirement. Now, if I need additional money above and beyond the 25, which by the time I'm 62, of course, I'll probably need 30, maybe 35,000, then I'm going to go to my Roth IRA, which will not skew the numbers and make my income greater, because the Roth IRA does not count as income for the Affordable Care Act. Why would it? I already paid taxes on all of that money, and you never pay taxes on the gains. However, if I did not have the Roth, which by the way, this is another major incentive of having the Roth if you retire early. If I use the traditional IRA, that would count as income because you're paying tax on all of that money, actually, because it's all pre-tax. See, I get confused over taxable account, which you already pay tax on the money you put in, versus the traditional IRA, which was the formal pre-tax of the former pre-tax of my 401k. Remember, that account's about $600,000. You pay tax on all of that, right? So the strategy then from 62, 63, and 64 will be Social Security, check for all 3 years if ACA is still around, and then fill in the gap of my income need with my Roth IRA. Now, as I think about closing this episode again, that is major in my mind as an incentive not to go back to work for part-time work, which I talked about, which I'm considering in a couple of months with my previous employer. So my previous employer is going to allow me to come back and do contract work if I choose to do so. I'm still thinking about it. I'm not going to say no yet. Come back and watch my episodes. I'll tell you what I'm going to do. But right now, I don't know. And the other thing I want to share with you in this episode before we relax and fall asleep, I hope you're not asleep yet, is that for next year, I'll be 60 years old. And for the following year, 2027, I'll be 61 years old. For those 2 years, yes, my taxable account, another incentive to build a taxable account if you retire early, is that I do need, and I will need, to sell the shares from that account, remember, to qualify for ACA. And I will share with you and figure that out as we go. I think I have enough capital gains in the taxable account to qualify for both of those years, which means I won't need to touch my traditional IRA, which I don't want to anyway, until many years into the future. Now, I also want to share, which I ramble about in an episode coming up this week, is that another light bulb went off for me. And it is this. When considering the income for 2026, remember, the number one goal is to qualify for ACA. And how do you make that happen? Well, I told you how to make it happen, right? You sell shares from the taxable account. That's what I'm going to do. That dollar amount, I'll nail down a little bit later. let's say it's 20,000, maybe something like that, to get the 16,000 need, because you have to pay tax on the capital gains. But here's a light bulb moment. I don't know where the market will be in 2026. Nobody does. You do not have to sell any shares until December of 2026. Because when you file your taxes in January of 2027, you're reconciling the income of 2026. And in the beginning of 2026 is when you tell Marketplace what you forecast your income to be. So what that means is, I have 3 options. And those options are for selling the shares. The 3 options would be, if the market is super high in January of 2026, most likely then, I will want to capture that transaction when the market is high. If it's above like the 6,200, which is the all-time high, the 6,147 or whatever it is, we know that the stock market is down. But if by that time it's high, it may be in my best interest to sell that 20 grand or whatever it is all at once and pump it into my checking account. Then I use that money for my expenses of 2026. However, if the market is down and I don't want to sell shares, remember, I don't have to for 12 months. I can do it in December of 2026. That's option 2. Lump sum. Now for option number 2, if that's what I end up doing, remember, I have my CD of 30,000 that's coming due anyway. That is the money I will use to pay my expenses. But then on paper then, I am putting the money back per se after I sell the shares. So it's a net to zero, if that makes sense. So even though I have to have that liquidity, if option 2 ends up happening. Option number 3 for selling the shares would be, I could sell shares every month. So I would take $20,000, if that's the number, and divide it by 12. And then sell the shares every month. And I think I would probably choose that option if the buzz or the vibe in the market is that we're on an upward trend. Perhaps. I have to think about that, right? It's just like the mindset of dollar cost averaging. Remember we talked about dollar cost averaging. If you're building your wealth, which many of you are, you don't want to time the market, right? So you buy shares every month. And if the market's up, you're buying a bunch of shares. If it's down, you buy even more shares. So I have to think through option number 3. And I have plenty of time to think about it, right? But there has to be an advantage to selling shares. It's almost like a CD ladder. Like, you would never want to create what is called a CD ladder, a certificate of deposit ladder, if the rates are not forecasted to go up. You would be doing a ladder, because then you would purchase like a 6-month CD and capture the rate. Then in 6 months you buy another CD for a year and you capture a higher rate. And then the next 3 years you do another one and you capture another higher rate. That's when you want to be doing a CD ladder. So it's kind of like that same thought process. Only I would be selling the shares to give me the income. Regardless, I've got the cash in that CD that will mature, as you know, that I can use cash as a buffer and then replenish it once the year comes to a close. So everybody, that is my episode for today. I hope you enjoyed it. If you did, give me a like. consider subscribing if you have not done so. And if you're still awake, make sure you come back tomorrow and the rest of the week for my episodes. Thank you so much for joining, and I'll see you guys